Welcome to Business Mentorship, the channel where powerful ideas meet practical action. Here, we transform world-class books on business, mindset, and personal growth into professional, voice-ready audiobook summaries designed for entrepreneurs, creators, and lifelong learners like you. Each summary is carefully written, clearly narrated, and structured to give you the core lessons and strategies in one smooth, focused listening experience. Whether you're building a brand, scaling a business, or mastering your mindset, you're in the right place. Now sit back, take notes if you'd like, and enjoy today's summary, brought to you by Business Mentorship. Introduction. Why behavior matters. More than knowledge when it comes to money, intelligence is rarely the most important factor. People with high IQs can make poor financial decisions. People with modest incomes can quietly become wealthy. And often, those who appear rich are living on the edge of financial collapse. The key difference? Behavior. In The Psychology of Money, Morgan Housel reveals a simple truth. How we think about money, our attitudes, fears, habits, and hopes, matters far more than what we know. Financial success is not a hard science. It's a soft skill, a mindset. It's not about spreadsheets, it's about self-awareness. Not about formulas, but philosophy. This book explores the way people actually behave with money, and why doing well with it often has less to do with how smart you are, and more to do with how patient, humble, and consistent you can be. This isn't a book about how to beat the market. It's about how to avoid being your own worst enemy. It's about mastering the psychology behind financial decisions, so you can build a life of freedom, security, and peace of mind. Chapter 1. No One's Crazy. Imagine two people. One grew up during the Great Depression. Their childhood was marked by scarcity, unemployment, and fear. They distrust the stock market, prefer saving over investing, and value financial safety above all. The other was raised in a booming economy, low inflation, a rising market, and easy credit. They see investing as a path to freedom, take risks with confidence, and assume markets always recover. Both people are acting logically. Both are behaving in ways shaped by their personal experiences. And that's the point. When it comes to money, no one is crazy. What looks irrational from the outside often makes perfect sense from the inside. Our financial behavior is shaped less, in byfacts and more, by the unique lens of our past. How we were raised, the economic conditions we lived through, and the stories we've told ourselves. This is why people can come to wildly different conclusions about the same financial question. Some fear debt, others leverage it. Some avoid stocks, others see them as essential. These aren't mistakes, they're perspectives. Understanding this is critical. If you believe that others are wrong just because they act differently, you'll miss the deeper truth. Personal finance is personal, and while data matters, context matters more. When someone invests cautiously, saves aggressively, or spends freely, they're expressing their emotional relationship with money, not just their logic. If you want to improve your own financial life, start by accepting this truth. People make decisions based on their unique life story, not a shared spreadsheet, and that includes you. The takeaway from this chapter is powerful and humbling. People make choices with money based on how the world has treated them, and that's not crazy. It's human. Chapter 2. Luck and Risk. When Bill Gates was in high school, he had access to a computer, an extraordinary rarity at the time. His school, Lakeside, was one of the few in the world that had one in 1968. That access gave him thousands of hours to practice, experiment, and fall in love with technology. From there, Gates went on to co-found Microsoft and build one of the most iconic companies in history. But here's what's often left out of the story. Another student at the same school, Kent Evans, was just as talented as Gates. He was his best friend and the person Gates expected to build a business with. But Kent died in a mountaineering accident before graduation. Same school, same opportunity, same intelligence. Completely different outcomes. This is the lesson of luck and risk. They are real forces, invisible but powerful, and they shape our financial outcomes, more than we like to admit. It's easy to look at someone's success and say, they worked hard, they earned it. And it's easy to look at failure and say, they made poor choices. But reality is far messier. Luck and risk are two sides of the same coin. They can both influence results, even when the effort is equal. And that's why copying others, especially financial icons, can be misleading. What worked for them may have included a hidden dose of luck that can't be replicated. The takeaway here is humility. Be careful when judging outcomes, both yours and others. And remember, when it comes to money, doing well requires a mindset that respects the role of chance and doesn't confuse it with certainty. Chapter 3. Never Enough. There's a famous story about a wealthy hedge fund manager attending a party hosted by a billionaire. During the event, the hedge fund manager is told, "This billionaire made more money this week than you've made in your entire career." The manager smiles and replies, "Yes, but I have something he'll never have." Enough. The pursuit of more is natural, but when it becomes endless, it becomes dangerous. Morgan Housel argues that one of the most valuable financial skills isn't ambition. It's knowing what's enough. Enough is realizing you don't need to outperform everyone. Enough is being content without comparison. Enough is understanding that reputation, freedom, and peace of mind are more valuable than an extra zero in your account. The financial world is filled with examples of people who had everything and lost it because they didn't know when to stop. They took one more risk, chased one more return, crossed one more line. The hardest financial skill is not getting rich. It's staying rich, and staying rich requires a mindset that resists the pressure to compete endlessly. The takeaway is this: know what enough looks like for you, define it clearly, and once you reach it, have the discipline to stop chasing. Because the moment you sacrifice stability for just a little more is the moment you start losing everything you already had. Chapter 4. Confounding. Compounding. Warren Buffett is one of the richest people in the world. But what most people miss is this: the vast majority of his wealth didn't come from extraordinary investing. It came from starting young and staying consistent for decades. Buffett began investing as a child and kept doing it for over 75 years. The power behind his fortune isn't found in the complexity of his strategy. It's found in the duration of his timeline. Compounding is a force that builds momentum slowly, then explodes. But it only works if you give it time. This is what makes compounding so difficult for most people. It's boring at first. It looks like nothing is happening. But patience is what turns small gains into staggering wealth. We're often tempted by fast results, quick returns, impressive outcomes. But the truth is, most long-term success, financial or otherwise, is simply the result of being consistent for a long time. When you understand compounding, you stop asking, "How can I get rich quickly?" and start asking, "How can I stay consistent long enough for growth to explode?" The takeaway is clear. Don't interrupt compounding unnecessarily. Don't trade decades of steady progress for months of excitement. Time is the most powerful financial lever you have. Use it wisely. Chapter 5. Getting wealthy versus staying wealthy. Getting rich and staying rich are two entirely different skills. Getting rich requires taking risks, being optimistic, and seizing opportunities. Staying rich requires humility, caution, and a relentless focus on survival. Morgan Housel points out that many people who earn a fortune eventually lose it because they fail to shift their mindset. They keep taking the same risks that made them rich even when they no longer need to. The most overlooked aspect of building long-term wealth is not ambition, it's endurance. It's avoiding ruin. It's making sure you're still standing tomorrow, next year, and in the decades to come. Wealth that lasts is built on consistent returns over a long time. And to do that, you need to avoid the big mistakes: financial ruin, reputation damage, and overexposure. Staying rich is about planning for things you can't see. It's about respecting uncertainty, staying paranoid enough to prepare, and being humble enough to admit that no one can predict the future. If getting money is a sprint, keeping it is a marathon. It's not about maximizing every opportunity. It's about surviving the slow compounding of smart decisions repeated over time. The key lesson: you don't need to be brilliant to get wealthy. But to stay wealthy, you must be consistently careful. Chapter 6. Tails. You win. Not all outcomes are created equal. Some decisions, some investments, some products deliver extraordinary results far beyond expectations. These outliers are what Housel calls tail events. In finance, a small number of trades often produce the vast majority of gains. In business, one product may make up for 100 failed ideas. In life, a handful of decisions shape decades of outcomes. The biggest wins, the tails, are but massively impactful. And the problem is, they're unpredictable. The takeaway is this: don't expect every action to have equal weight. Most won't. But the few that do matter a lot. Rather than trying to be right all the time, aim to stay in the game long enough to catch a few of those rare, outsized successes. Investing. This means allowing room for volatility and being patient through losses to capture big gains. In business, it means giving yourself enough shots at success so that one breakthrough can carry the rest. Let your strategy embrace the idea that the biggest rewards come from a few rare events, and build your behavior around that truth. Chapter 7. Freedom, True Wealth. Housel argues, isn't measured by money, it's measured by control over your time. We think of wealth as owning things, cars, houses, watches. But real wealth is waking up and choosing how to spend your day. It's the ability to say no, to decline obligations, to protect your schedule. Time is the ultimate form of freedom, and yet so many people trade it away for the illusion of wealth. They sacrifice flexibility for a bigger paycheck, prestige, or material success, only to realize they've lost control over their most valuable asset. The irony is that many people spend money trying to impress others or buy status, while what they really want is peace of mind. Housel emphasizes that the highest dividend money pays isn't luxury, it's autonomy. Being able to decide how you live, work, and spend your life is the true return on financial success. The goal of money should not be to impress others, it should be to free yourself. Chapter 8. The Man in the Car. Paradox. Have you ever seen someone driving a luxury car and thought, that person must be successful? Here's the paradox. Housel explains that no one is actually impressed by the person driving the car. They're too busy imagining themselves driving it. We buy nice things to signal success, but the message rarely lands the way we think. People don't admire you for what you own. They admire the idea of having those things themselves. Trying to impress others through displays of wealth is a losing game, because it chases a form of respect that can't be bought. It's invisible, and most of the time, people are too focused on their own lives to even notice. The irony is that those who spend the most trying to be admired often end up being ignored. Real respect comes from humility, generosity, and integrity, not from material displays. The takeaway from this chapter is simple but powerful. If you're spending money to win admiration, you're likely not getting the return you hoped for. True status is felt, not flaunted. Chapter 9. Wealth is what you don't see. We often judge people's wealth by what they display: clothes, cars, homes, and lifestyle. But as Housel reminds us, wealth is what you don't see. A new car might signal financial success, but in reality, it only proves that the person had enough money to buy it, then no longer has that money. True wealth is hidden. It's money in the bank, investments that aren't flashy, and assets that generate freedom but don't announce themselves. That's why it's so easy to misunderstand someone's financial position. The people who appear rich may be deeply in debt. The ones who live modestly may be financially free. Spending is visible, saving is not. And because we can't see what others save, we underestimate its value. The takeaway is this: stop judging your success by how much you spend. And don't compare your life to someone else's highlight reel. Wealth is quiet. Its benefits are personal, not performative. Chapter 10. Save money. Saving money isn't just a strategy, it's a mindset, and one of the most underappreciated financial skills. We often think of saving as a goal with a purpose, saving for a house, for a car, or for retirement. But Morgan Housel explains that saving is most powerful when it's used to create options. Savings give you flexibility. They buy time when you need it. They give you the freedom to say no. They help you handle the unexpected, switch careers, take a risk, or walk away from a bad situation. And here's the most important insight. You don't need a specific reason to save. Just saving for the sake of security is a perfectly valid. Well, you don't have to be a high earner to be a great saver. It's not about income, it's about behavior. People often ask, what's the best investment I can make? The answer is your ability to live below your means and build margin into your life. The takeaway: saving isn't about depriving yourself. It's about creating breathing room for your future self to make better decisions. Chapter 11. Reasonable. Irrational in personal finance, being perfectly rational, isn't always realistic. Housel explains that it's better to be reasonable than to be purely rational. A rational investor might sell all their stocks in a downturn if the numbers justify it. A reasonable investor might hold on, not because the math says so, but because they know it helps them sleep at night. Money decisions are deeply emotional. They involve fear, hope, insecurity, and pride. Pretending that humans can make financial decisions like robots is both unrealistic and dangerous. What matters most is not maximizing returns, but creating a plan you can stick to over time. That requires emotional compatibility. It means acknowledging your own psychology and designing strategies that feel right for you, even if they aren't mathematically perfect. Consistency beats brilliance. And consistency comes from behavior you can live with. The lesson is this: don't aim to be coldly logical. Aim to be calm, steady, and honest with yourself. Chapter 12. Surprise. The most important events in the economy and in your life are the ones you don't see coming. That's why Housel urges us to expect the unexpected. Financial history is full of surprises. No one predicted the housing crash, the global pandemic, or the dot-com bubble in real time. And yet, each of those events changed the world. Because the biggest risks are always the ones that haven't happened yet, the best financial plan is one that can withstand shocks. The lesson here is about humility. If your strategy only works in good times, it's not a real strategy. Build one that assumes there will be recessions, downturns, and volatility. Rather than trying to predict every surprise, prepare for surprises in general. Expect them. Accept them. Structure your finances with room to absorb them. Success doesn't go to the best forecaster, it goes to the most adaptable. Chapter 13. Room for error. Room for error means having a margin of safety. It's the cushion that protects you when things don't go as planned. In finance, that might look like having more cash than you think you need. It might mean being more conservative with investments. It's about avoiding the edge, because the edge is where mistakes happen. Housel argues that people fail financially not because of bad ideas, but because they don't leave space for bad outcomes. Planning with no room for error is like driving without brakes. You may be going fast, but one unexpected curve and it's over. Even if you feel confident, even if the odds are in your favor, give yourself a margin. Room for error protects against risk, it protects your confidence, and it gives you time to adjust when life throws you something new. The takeaway is simple. Being slightly less aggressive can often make you vastly more successful in the long run. Chapter 14. You'll change what you value today might not be what you value in 10 years. And that's a problem, because most financial plans are built around long-term goals. Morgan Housel emphasizes a crucial but uncomfortable truth. People change. Their goals, priorities, and definition of success evolve over time. Yet we tend to plan our lives as if our future self will want exactly what we want now. This creates tension. We may lock ourselves into mortgages, careers, or investment strategies that no longer fit who we've become. The result is regret, or worse, feeling. Trapped by past decisions. This chapter is a call for flexibility. Instead of building rigid plans, build adaptable systems. Expect your values to shift, allow room for updates. And most importantly, don't punish your past self for not knowing what you now understand. The takeaway: planning is essential, but so is adjusting. Make peace with your evolving identity and give your future self the freedom to make better decisions with better information. Chapter 15. Nothing's free. Everything has a price. The question is whether you're willing to pay it. In investing, the price is volatility, uncertainty, and occasional losses. In business, the price is stress, risk, and delayed gratification. But most people don't see it that way. They think of price as something you pay once. Housel reframes it. Volatility and stress aren't fees. They're the cost of admission to long-term wealth. And here's the key insight. If you expect rewards without discomfort, you'll quit the moment things get hard. But if you accept the price as part of the process, you'll stick with it longer, and that's where success lives. The stock market doesn't promise easy growth. It promises that if you can endure the ride, you'll be rewarded over time. Wealth, in any form, always comes at a cost. Understanding and embracing that cost is what separates those who succeed from those who give up too soon. The takeaway: learn to identify the price of success and decide if you're willing to pay it. If you are, don't complain when the bill comes due. That's the deal you made. Chapter 16. You and me. One of the biggest mistakes in personal finance is assuming that what works for someone else should work for you. Housel explains that financial decisions are deeply personal. Your background, your goals, your risk tolerance, and your time horizon are different from everyone else's. That's why you shouldn't blindly copy what other people do with money. You may be playing a completely different game. For example, a day trader is playing for short-term profits. A retiree is playing to preserve capital. An entrepreneur might be playing for long-term equity growth. Their strategies might look smart to you, but they only make sense in the context of their own game. This chapter reminds us that money is not one-size-fits-all. Be clear about what you're playing for, and be cautious when taking advice from someone who's playing a different game. The key lesson is this: define your game, your goals, and your timeline. Build your financial life around what matters to you, not what looks impressive to others. Chapter 17. The Seduction of Pessimism. Pessimism sounds smart. Optimism often sounds naive. But Morgan Housel argues that, in finance, optimism is not only realistic, it's essential. Why? Because the historical trajectory of progress, economically and socially, is upward. Markets recover, innovations unfold, and humanity adapts. Yet we're naturally drawn to pessimistic voices, especially in the media. Fear sells. Bad news feels urgent. But consistently betting against progress can be financially disastrous. Those who stay in the market, remain hopeful, and understand the cycles of downturn and recovery are usually the ones who build lasting wealth. The key is not blind optimism, but rational optimism, knowing that while setbacks are inevitable, long-term improvement is the norm. If you want to build wealth and peace of mind, learn to filter out the daily noise. Expect volatility, anticipate uncertainty, but don't abandon the belief that progress is possible and likely. Chapter 18. When you'll believe anything. Money decisions aren't just about numbers, they're about the stories we tell ourselves. In this chapter, Housel explores how humans use narratives to make sense of complex financial situations. We seek meaning, especially when data is unclear or the world feels chaotic. This storytelling instinct can be helpful, but it can also be misleading. We might justify risky behavior with optimistic stories. This time is different. Or we might anchor our confidence to a past success, assuming it guarantees future results. In truth, the world changes. Markets shift. Our stories often lag behind. Being aware of this cognitive bias is critical. It doesn't mean ignoring intuition, but it does mean testing your stories against reality. The The most effective investors learn to question their own assumptions. They stay flexible. They look for evidence, not just confirmation. In short, be mindful of the narratives that drive your decisions. Are they rooted in truth or comfort? Conclusion. Confessions. In the final chapter, Housel shares a transparent confession. He hasn't always made perfect financial decisions. Like everyone else, he's been shaped by emotion, environment, and personal bias. This admission reinforces one of the book's core messages. There is no one right way to manage money. What matters most is creating a strategy that works for you. One that fits your values, your goals, and your emotional tolerance. Some people save aggressively. Others invest more freely. Some want early retirement. Others want to build a legacy. All of these paths are valid, if they align with your personal definition of success. Ultimately, the psychology of money isn't about mastering markets. It's about mastering yourself. Wealth, happiness, and peace of mind come from understanding your own behavior, managing your expectations, and staying consistent with your long-term vision.